When you hear the word stock, what's the first thing that pops into your head? For a lot of us, it's probably a ticker symbol, right? A little abbreviation on a screen with a price that's either flashing a happy green or a very angry red. But if that's all you see, you are missing the entire point. Seriously. Thinking a stock is just a number you trade is probably one of the biggest, most common mistakes in all of investing. So today, we're going to wipe the slate clean and go right back to first principles. So let's just start with the most fundamental question there is. When you're in your brokerage account and you click that buy button on one share of, say, Apple or Microsoft, what did you actually just purchase? The answer is so much bigger than just a digital receipt. It's really about ownership, it's about rights, and it's about having a real claim on a real business. You see, you've got this common view on one side. It's a ticker, a price, something to speculate on, buy low, sell high. But the reality? Oh, the reality is so much more solid. It's a real certificate of ownership. It's a stake in an actual operating business. And it's a bundle of legally protected rights. Getting the difference between these two views, well, that's the key to switching your brain from being a speculator to being an owner. Okay, so here's our game plan. We're going to start with the legal reality of what you actually own. Then we'll figure out your claim on the company's profits. After that, we'll cover your rights as an owner, see how you actually get paid, and then we'll pull it all together into what we call the owner's mindset. All right, first things first, we've got to talk about the legal foundation of this whole thing. A stock isn't just some abstract idea. It's a very precise legal document. Think of it like a title deed, but instead of a house, it's for a tiny piece of a corporate empire. Now, the first big idea you have to wrap your head around is this concept of the corporation as a legal person. This is a huge deal. It means the corporation itself, the legal entity, is what owns the factories, the patents, and the cash in the bank. You, as the shareholder, don't own the company's delivery trucks directly. No, you own a piece of the entity that owns the trucks. And that little distinction is absolutely crucial. And here's why that separation is so powerful. It creates something called limited liability. Because the corporation is its own legal person, its debts are its own, not yours. So if the company goes belly up and has creditors banging on the door, they can't come after your car or your house or your savings account. The absolute most you can ever lose is the money you put in to buy the stock. And that legal shield right there is what makes it possible for millions of regular people to invest. Okay, so that's the legal protection side of ownership. But what about the money? What about the economics of it? As an owner, what are you financially entitled to? Well, it all comes down to your place in the financial pecking order. The term you need to know here is residual claim. And residual is just a fancy word for leftovers. As a common stockholder, you get what's left after everyone, and I mean everyone else, with a claim on the company has been paid. You are last in line. This whole hierarchy is known as the capital stack. Think of it like this. If the company were to be sold off for parts, the first people to get their money back are the debt holders, so the banks and the bondholders. After they're paid in full, then the preferred stockholders get their cut. And way down here at the bottom, hoping there's something left, that's us, the common stockholders with our residual claim. Now, this position explains both the huge risk and the incredible reward of owning stocks. If things go south, you could get nothing. But if the business is a massive success, all of that upside, everything beyond its fixed promises to others, belongs to you. Now, being last in line for the money means you have the most at stake, right? And that's exactly why ownership also comes with power. These are not just some theoretical ideas. These are legally protected powers that let you influence the very company you own a piece of. Your most important right by far is the right to vote. The standard deal is one share, one vote. And you use this power to do some pretty important stuff, like electing the board of directors. They're basically your representatives, hired to keep an eye on management for you. You also get to vote on massive corporate decisions, like whether the company should be sold. And for most of us, we vote by proxy, which is basically just an absentee ballot that you can fill out online. It's also super important to know that not all stock is created equal. What we've been talking about this whole time is common stock. That's the stuff that gives you voting rights and that juicy, unlimited upside potential. But there's another kind called preferred stock. Think of it like a hybrid between a stock and a bond. It gets priority for fixed payments, which is safer, but in exchange for that safety, preferred owners usually give up their voting rights and they don't get to participate in the company's explosive growth. Okay, so we've established that a stock is ownership, It comes with rights, and it gives you a claim on the leftovers. But how does that ownership actually translate into money in your pocket? Well, there are basically three main ways that value flows from the business to you, the owner. First up, you've got dividends. These are simple, direct cash payments from the company's profits, sent right to your brokerage account. Second, a company can do share buybacks. This is where it uses its own cash to buy its own stock off the market, which reduces the total share count and automatically makes your slice of the pie bigger. And third, there's capital appreciation. This is what happens when the rest of the world realizes how valuable the company is, and the price of your stock goes up over time. You know, this idea of your ownership percentage changing can feel a little abstract, so let's make it super real. We're going to use a simple example with a totally made-up company we'll call Growth Gadgets Corp. This is where you can really see the hidden power of being an owner. All right, let's set the stage. Growth Gadgets has 100 shares of stock in total, and you own 10 of them. Pretty simple math, right? That means you own exactly 10% of the entire company. Now keep your eye on that 10% slice of the pie. So in scenario 1, let's say the company needs to raise some cash. To do that, it creates and sells 10 brand new shares to a new investor. Now there are 110 total shares out there. You still have your 10 shares, but your ownership has been diluted. You've gone from owning 10% of the business down to just over 9%. Your piece of the pie literally just got smaller. Okay, now let's flip it and look at the opposite, a buyback. This time, the company is doing well and has extra cash. It uses that cash to buy 10 shares from other investors on the market and just, poof, makes them disappear. Now the total number of shares has dropped to 90. You still just hold your original 10 shares, but look what happened. Your ownership stake has automatically grown to over 11%. Without you lifting a finger, your piece of the pie just got bigger. That is the magic of a share buyback. So what's the point of all this? Where does it all lead? It leads to a fundamental, game-changing shift in how you see investing. The real goal here is to move from being a nervous price watcher glued to the screen to being a calm, engaged business owner. And that mindset is what allows great investors to ride out the crazy ups and downs of the market, because their focus isn't on the daily price swings, it's on the long-term health of the business they co-own. And this brings us to the single most important thing I want you to walk away with today. I'm going to say it plainly. You are not buying a ticker symbol. You are buying a fractional ownership stake in a living, breathing business, a company with real products, real employees, and real-world challenges and opportunities. So to put this whole owner's mindset into action, here are 5 powerful owner-like questions you should ask yourself before you ever invest a dime. 1, what am I actually buying here? Is it common stock? What are my rights? 2, where do I stand in line in that capital stock? 3, how does this company plan to get cash back to me, the owner? 4, is my ownership stake likely to shrink over time from dilution or grow from buybacks? And finally, 5, who is in charge here and do I trust them to look out for my interests? Thinking this way, well, that's the real foundation of long-term success. So you've done it. You've taken the first and honestly the most critical step. You now understand what a stock truly is. It's ownership. But that immediately leads to the next giant question, doesn't it? Now that you know what a stock is, how in the world do you figure out what it's actually worth? We'll tackle that one next time. Thanks for joining me.